The word recession makes most investors do one of two things. They either panic and sell everything, or they freeze and do nothing. Both responses cost them money. And both happen because most people have never been taught what a recession actually is, how to see one coming, and what the historically proven response looks like. This is week 8 of The Algorithm Investor. Today we are covering recessions, what they are, the warning signs that appear before they hit, how they affect your investments, and the specific steps that protect and grow your wealth through an economic downturn. Let us start with the definition. A recession is technically defined as 2 consecutive quarters of negative GDP growth. GDP, gross domestic product, is the total value of all goods and services an economy produces. When the economy shrinks for 2 quarters in a row, businesses pull back on spending, unemployment rises, consumer confidence falls, and the stock market almost always declines, sometimes dramatically. But here is what that definition does not tell you. Recessions are a completely normal and recurring feature of every capitalist economy. The United States has experienced 13 recessions since World War II. On average, 1 every 6 years. They are not anomalies. They are not signs the system is broken. They are part of the natural economic cycle: expansion, peak, contraction, trough, and recovery. Every single time without exception. And here is the most important historical fact about every recession in American history. Every single one has ended. Every single one was followed by a full recovery. And in most cases, the stock market reached new all-time highs within 2 to 5 years of the bottom. The investors who suffered permanent financial damage in recessions were not the ones who stayed invested. They were the ones who panicked, sold at the bottom, and either stayed in cash or bought back in at much higher prices during the recovery. Now let us talk about warning signs. No indicator predicts recessions perfectly. Anyone claiming they can call the exact timing of a recession is either lucky or not being honest. But several leading indicators have historically appeared before recessions and are worth understanding. The first and most reliable is the yield curve inversion. Under normal conditions, long-term government bonds, like the 10-year Treasury, pay higher interest rates than short-term bonds like the 2-year Treasury. The longer you lend money, the more compensation you expect for the risk. When short-term rates rise above long-term rates, the yield curve inverts. This has preceded every U.S. recession in the past 50 years without exception. The lag between inversion and recession can be anywhere from 6 to 24 months, but it remains the most consistent early warning signal available. The second warning sign is rising unemployment claims. When businesses start laying off workers in increasing numbers, it signals companies are cutting costs ahead of slower growth. A sustained upward trend in weekly jobless claims over several months is a meaningful signal. The third is falling consumer confidence. Consumer spending drives approximately 70% of the U.S. economy. When people feel uncertain about their jobs and financial future, they spend less. When spending contracts, economic growth follows. The fourth is the manufacturing PMI, the Purchasing Managers Index. This monthly survey measures whether business activity is expanding or contracting. A reading below 50 for several consecutive months indicates contraction and has historically preceded recessions. The fifth is widening credit spreads. When investors become fearful, they demand higher interest rates to lend money to corporations. When the gap between corporate bond yields and government bond yields widens sharply, it signals rising fear in credit markets, which typically precedes broader economic stress. Now the question every investor actually wants answered. How should you respond when a recession arrives or appears to be approaching? The answer starts not with your investment portfolio, but with your financial foundation, specifically your emergency fund. If you do not have 3 to 6 months of living expenses in a high-yield savings account, that is your first priority before any investment conversation. In a recession, unemployment rises and job security falls. An emergency fund is what prevents you from being forced to sell investments at the worst possible time just to pay your bills. With your emergency fund secure, here is the evidence-based response to a recession for a long-term investor. Do not sell. This sounds simple. It is psychologically one of the hardest things an investor faces. When your portfolio is down 30% and every headline is predicting economic catastrophe, selling feels like the only rational response. But the data is unambiguous. Investors who stayed fully invested through the 2008 financial crisis, when the market fell 57% and held without selling, saw their portfolios recover completely by 2013 and go on to reach record highs. Investors who sold at the bottom in early 2009, when fear was at its peak, locked in their losses permanently and missed one of the greatest bull markets in history that followed immediately after. The second response is to keep investing. If you have automatic monthly contributions set up, do not stop them during a recession. You are buying at lower prices. Every dollar you invest when markets are down buys more shares than the same dollar invested at a market peak. This is the counterintuitive truth about recessions for long-term investors. A market downturn is not a disaster. It is a sale. The same companies you wanted to own at higher prices are now available at a discount. The investors who built the most wealth from the 2008 crisis were not the ones who predicted it and sold everything in advance. They were the ones who kept their automatic contributions running and bought consistently through the downturn. The third response is to review your asset allocation. A recession is a useful moment to honestly assess whether your current portfolio matches your actual risk tolerance, not the risk tolerance you thought you had when markets were rising. If a 30% portfolio decline is causing you genuine financial or psychological distress, that is a signal your allocation is too aggressive for your actual situation. Recessions reveal your real risk tolerance in a way that bull markets never can. This does not mean selling in a panic. It means making a deliberate decision, when you are calm, to adjust your allocation to one you can genuinely hold through a downturn without making emotional decisions. The fourth response is to evaluate your income sources. In a recession, job losses increase across many industries. This is the moment to honestly assess how stable your income is, whether you have marketable skills in recession-resistant fields, and whether any additional income streams might be worth developing. Personal finance and investing, the exact topics this channel covers, tend to see increased interest during recessions as people suddenly become more motivated to understand and manage their money better. If you are watching this channel during or approaching a recession, you are already doing the right thing. Let us talk about recession-resistant investments. These are not guaranteed to hold their value, but have historically shown more stability than the broad market during economic downturns. Consumer staples companies, food, beverages, household products, personal care. People continue buying these regardless of economic conditions. Companies like Procter & Gamble, Coca-Cola, and Walmart tend to hold up better than cyclical businesses during recessions. Healthcare stocks similarly tend to be more defensive. People do not stop needing medical care because of a recession. Large pharmaceutical companies and healthcare REITs have historically shown relative resilience. Treasury bonds, particularly long-duration government bonds, often rise in price during recessions as investors flee to safety and the Federal Reserve cuts interest rates to stimulate the economy. Bonds and stocks tend to move in opposite directions during recessions, which is the core logic behind the classic 60% stock and 40% bond portfolio. Gold has historically served as a store of value during economic uncertainty. It does not generate income, but it tends to hold purchasing power when confidence in paper currencies and financial systems is low. Here's the practical takeaway from everything we have covered today. You cannot predict recessions with certainty. Nobody can. But you can prepare for them in a way that means when they arrive, and they will arrive, you are financially and psychologically positioned to survive them without permanent damage. Emergency fund fully stocked. Asset allocation matched to your real risk tolerance. Automatic contributions running regardless of market conditions. A diversified portfolio with some defensive exposure. And the historical knowledge that every single recession in American history has ended. That combination does not guarantee you will feel comfortable during a recession, but it does guarantee that you will not be forced into the decisions that turn temporary market declines into permanent financial losses. Next week on The Algorithm Investor, Week 9, we are covering compound interest in depth, the math that Albert Einstein allegedly called the eighth wonder of the world and the single most powerful force in building long-term wealth. For the full breakdown on everything you need to build real wealth, subscribe to The Algorithm Investor. New video every single week. Drop a comment below. Does the idea of a recession worry you as an investor? Yes or no? I read every single comment. See you next week.